Today, we journey through two defining eras of modern finance. The 2008 financial crisis, one of the most devastating economic events since the Great Depression, and the turbulent decade that followed, from 2016 to 2026, when several American banks once again found themselves on the brink. We begin with the disaster that reshaped the world, the 2008 global financial crisis. The 2008 financial crisis, also known as the global financial crisis or the Panic of 2008, stands as the most severe economic downturn since the Great Depression. Although it originated in the United States, its shockwaves rippled rapidly across global markets. According to Britannica, the crisis began with the collapse of the U.S. housing market and led to a dramatic contraction in global liquidity. As major institutions approached failure, the world entered what would be known as the Great Recession, lasting from 2007 to 2009. Economists agree, no single factor caused the crisis. Instead, it was the convergence of systemic failures. After the early 2000s recession, the dot-com crash, and the shock of 9/11, the Federal Reserve slashed interest rates from 6.5% in 2000 to just 1% by 2003. Cheap money flooded the economy, encouraging excessive borrowing and inflating housing demand. These low rates fueled a historic housing boom. Even subprime borrowers, those with poor credit, were pulled into the market as lenders sought profit in volume rather than safety. Financial institutions increasingly targeted low-income borrowers with deceptive terms and high-risk loans. Regulators failed to intervene while risky mortgages proliferated. Instead of holding mortgages, banks packaged them into complex securities tied to subprime loans. These products were marketed globally as safe investments. When borrowers began defaulting, these securities collapsed in value and transmitted losses worldwide. Earlier deregulation, including the partial repeal of the Glass-Steagall Act, allowed riskier investment practices to blend with traditional banking, creating new systemic vulnerabilities. Let's trace how the crisis unfolded. Early 2000s, low interest rates ignite the housing boom. 2006, home prices fall, adjustable rate mortgages reset. Borrowers begin to struggle. 2007, subprime lenders file for bankruptcy. Hedge funds holding MBS collapse. Liquidity evaporates. 2008, on September 15th, Lehman Brothers files for bankruptcy with $639 billion in assets and $613 billion in debt, the largest such filing in U.S. history. Markets plunge, panic spreads. Consumers overborrowed, banks overlent. Verification became lax. When defaults began, mortgage-backed securities collapsed globally. Borrowers found themselves underwater, fueling unprecedented foreclosure rates. Banks, unable to trust one another's balance sheets, halted lending. Global credit seized. After Lehman's collapse, markets plunged and panic became widespread. The U.S. launched TARP, authorizing $700 billion to stabilize banks, AIG, and the auto industry. Though the crisis began in the United States, its impact circled the globe. Subprime defaults devastated banks and investment firms. Because mortgage-backed securities were held worldwide, losses cascaded through Europe, Asia, and beyond. Countries like Iceland experienced full banking collapses, and the crisis contributed to Europe's sovereign debt crisis. When the crisis ended, millions had lost homes, major institutions had collapsed, and trillions in wealth had evaporated. The crisis transformed financial regulation, reshaped economic policy, and remains etched in global memory. Although the worst seemed behind us, the decade from 2016 to 2026 revealed new vulnerabilities, some eerily reminiscent of 2008, others unique to the digital age. In the years after 2016, the banking landscape appeared stable, but beneath the surface, cracks remained. 2016, 5 bank failures, including Allied Bank and North Milwaukee State Bank. 2017, 8 failures, including Seaway Bank and First NBC Bank. From 2018 to 2022, remarkable calm returned. No failures in 2018, 2021, or 2022. In 2022, the Federal Reserve began aggressively hiking interest rates. For many banks, this was the match that lit a fire. A 2023 study revealed 186 U.S. banks were at risk if uninsured depositors withdrew funds. Risks stemmed from mark-to-market losses and heavy dependence on uninsured deposits. It was the perfect setup for digital age contagion. Silicon Valley Bank, once the financial backbone of America's innovation economy, became the first major domino to fall. It collapsed because bond values plunged as rates rose. Its depositor base was mostly uninsured startups. A social media-driven panic triggered the fastest modern bank run. Within 48 hours, SVB was gone, sending shockwaves worldwide. Just days later, Signature Bank fell. Deeply tied to cryptocurrency clients and reliant on uninsured deposits, it collapsed under the same pressures: fear, withdrawals, and evaporating confidence. Next came First Republic Bank, serving high-net-worth clients across the coasts. Its downfall: massive uninsured deposits, rapid post-SVB withdrawals, inability to stabilize its balance sheet. It became the largest bank failure since Washington Mutual, later purchased by JP Chase. 2023, 5 bank failures total, including SVB, Signature, and First Republic. 2024, Republic First Bank failed, acquired by Fulton Bank. 2025, 2 additional failures signaled lingering instability. By 2023, researchers warned nearly 190 banks were vulnerable to depositor runs. Over $300 billion in insured deposits could be at risk under stress. These were not fringe players. They included regional and specialized banks across the country. In 2026, FDIC data shows 0 bank failures so far. But in an age of instant withdrawals and viral panic, stability can be temporary. From the collapse of Lehman Brothers in 2008 to the sudden implosions of Silicon Valley Bank, Signature Bank, and First Republic a decade later, the financial world has learned painful lessons. The crises of 2008 and 2023 were separated by time, but connected by themes: excessive risk, regulatory blind spots, and the fragile psychology of financial trust. Today, banks are more transparent and better supervised. But as history continues to remind us, confidence is the true currency of finance. When it vanishes, even giants can fall. This has been From Crisis to Contagion: Banking Failures from 2008 to 2026. Thank you for watching.